Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for December 1st of 2024. Certainly welcome you to the chart pack this week. I hope all of you had a wonderful Thanksgiving week. Were able to spend it with family and friends and had safe travel if you were on the road. As we get started here in the last month of 2024, I think we're going to begin to kind of like ease into some forecasts here and kind of give you maybe a little bit of perspective on our thinking for 2025, which I do think is going to be a positive year, but I do think there's going to be more volatility overall in the equity markets. I think the economic data has the potential to be reasonably good. I think the one thing that we're not quite sure of is whether inflation is going to turn around from what you're looking at here in this chart. Obviously, we've had a really, really nice progression over a period of time in inflation. And what this chart shows you is inflation expectations 1 year ahead. And so this is the consensus, and we're actually past the election here now. And so there's been a lot of talk about tariffs and the impact of tariffs and how they drive up prices for domestic purchasers of imported goods. And that is money that is essentially revenue for the government, but it's prices we pay. And so there is a feeling that, that the magnitude of the tariffs that are being discussed by the incoming Trump administration are going to be such that it will add to inflation. It will, in other words, be inflationary next year. But that's certainly not the expectation right now. Now, this could change quite a bit. Now, we've made a lot of progress over the last couple of years and getting closer to the Fed's overall mandate. And you can see where we were in year ahead inflation expectations prior to the pandemic, and we're getting back into that band now. Of course, overall expectations for November were 3.9%. That's well above the Fed's 2.0% target. But I think we're going to be living in a world kind of getting back to our parents' generation a little bit, where, in the 50s and 60s, where 3% was a good yardstick for inflation. Here we have some economic data. I've got some Dallas and Richmond Fed data. You can see on the manufacturing index here for Richmond Fed, it has been fairly low. Of course, everything below zero represents contraction, but this is less negative. And we see inventory levels of finished products being a little bit higher. Of course, there's a lot of other charts related to these regional surveys that I don't put in the chart pack, but overall hiring intentions remain relatively muted. Expectations are a little bit better. They're more optimistic. I think I think the incoming Trump administration is being viewed as being less restrictive to commerce, and of course we'll have to wait and see. There was an announcement on a Trump pick for Commerce Secretary, but in any case, I think this is being viewed as pro-business. But what we see here is inventory levels that have been ratcheted up. We do note some improved capital spending expectations for manufacturing in particular. So, I think this data here is very consistent over many of the Fed districts, and we'll look at the Dallas Fed here in a slide or two. Here's the Dallas Fed manufacturing index. You can see that it is traversing a path very similar to the Richmond Fed, and we're much closer to the break-even line here. And so this is what I was referring to in the last slide when we're talking about the Richmond Fed data, is that in this pink area here, we've got expectations over 6 months for not only production, but also new orders. And you can see that these are trending higher, and you can see the relationship between these two data series on new orders and production, and they tend to follow each other. And so, it's very unusual to see gaps of this magnitude, particularly when you have a directional move in the actual data that belies what's going on with expectations. So, needless to say, expectations of manufacturing, whether you're talking about Richmond Fed, Dallas Fed, Kansas City, Philly, Empire State, I mean, they're all looking a bit better heading into 2025. Here we have the average in this dotted line here, the average regional manufacturing index, and then we have the actual ISM uh, index. So this would be the surveys, represented in the Fed, in the Federal Reserve data. And this is the ISM, which, as you know, is something that gets published every month for the Institute, from the Institute of Supply Management. Now, what we're looking at here is a little bit of a degradation, which seems to run counter to what I've just told you in some of the Richmond and Dallas Fed data. However, we see the regional manufacturing data, and this is incorporating Dallas and Richmond Fed. That's moving higher. And again, these relationships don't lie. And when they correlate pretty well over time, and you do get this kind of deviation, usually you're going to see the actual data begin to revert back to where you see those regional surveys. And so you can see here, we've got New York, Philadelphia, Dallas, and Richmond. And we've already talked about these in particular. But when you add New York and Philly to it, I mean, again, it paints a positive picture. And this is very consistent with not only New York, Philadelphia, and these four, but I mean, you've got the Kansas City Fed, you got the San Francisco Fed. I mean, you have regional Fed surveys that are all consistent in this upward expectation trend. All right, a bit of housing data here. We see a little bit of interesting deceleration in home prices on the Case-Shiller 20-city price index. You can see the expectation was for 0.3% increase, and it was less than that. Now we're still at a disparity here. This chart here from Fred, which is the St. Louis Federal Reserve Data Bank, and you can see that the house price index in the purple line continues to outpace average hourly earnings. And so, even though average real earnings are still positive, which is good for consumers, you still have housing prices, even though the prices may be in deceleration. And again, they were down in aggregate in 2022, and then went back up again, and now they're in deceleration mode, that they are still at a pretty hefty delta. So the affordability issue is still out there. And, we're going to be talking about housing a lot in 2025 because these tea leaves are somewhat mixed. You've got the rising generation, you've got people, as I've shown you in chart packs here, over the last several weeks, that people that tend to live at home a little bit longer. And, your first time home buyers tend to be a lot older now than they were even 10 years ago. And I think that's because of this delta here. And so this is not really telling you anything particularly new, other than to say that this is something that we're going to be talking about in 2025. All right, completed single family houses for sale. And you can see that number has really shot up. It was, this number, tends to oscillate. Obviously, we had a glut of new homes heading into the global financial crisis. And as you would expect, there was a shutdown of of building in the aftermath of the global financial crisis. Banks really tightened up on lending because that was a very cathartic period in our lives and in the business world. And you can see where that inventory has gone up, and then we had a real surge in post-pandemic demand that brought that number down. And so we've got an inventory level that is on the way up now, which you think from a supply and demand side, even though there is a lot of supply, you would think housing prices for at least new homes would go down, but I don't think that's going to be the case. We'll go ahead and transition into some charts on the market, and a lot to talk about here. Obviously, as we head into the new year in just a few short weeks, we have a lot of naysayers that look at the difference between the performance in the S&P 500 and the equal weighted S&P 500 index. And we've talked a lot about the disparity in valuations between the Magnificent Seven, the AI firms that are heavily leveraged to technology. And, we look at where we are now. And so this reflects kind of a naysayer's view that we're going to be real close to recession because of this disparity between the overall S&P 500 and the equal weighted index. Now, what I'm going to show you over the next few slides is that disparity is breaking down. We're seeing greater breadth in the overall market. And one thing that I'd like to point out here, even though it seems like, this delta has definitely provided some recessionary signals, that there's other things that have clearly been pointing at recession that just simply haven't panned out, like the index of leading economic indicators, which I've shown you over the last couple of weeks. So now we do take stock in this. It is relevant from a perspective standpoint. But what I'm going to show you now is over the next couple of slides is that we have increasing breadth. And just take note that the S&P 500 of today is not your father's S&P 500. It's become much more beholden to technology companies, and top 10 stocks in the S&P 500 index account for 30% of it, and most of those are technology firms. So this is going to act a lot like the NASDAQ now, more so than it ever has, and I think that has a lot to do with where we are here now. So in talking about that disparity, we've got that illustrated here. In the black line, we've got the S&P 500 next 12 months price to earnings ratio. So this is the forward PE ratio, which right now is about 22.5. And then we have here in this other kind of purplish line, or whatever you want to call it, the S&P 500 equal weighted index. And so again, we've been talking about that value disparity, and you can see these have had a really tight relationship, in a data series that goes back to 2014. I mean, really tight, actually. And then we had a little bit of breakout here post-pandemic, and then the trough in both. And then we've seen that kind of narrow out. And so a lot has been made about this gap that's been building. But directionally, you see that even the equal weights are picking up here. And so over time, that disparity is going to dissipate, in my estimation. And there's going to be reasons why you want to own the overall S&P 500, because that equal weighted index, I mean, you're having greater market participation. Even though there's a gap right now, we'll be looking for that gap to narrow in the coming months. Here we have some information from Deutsche Bank. S&P 500 quarterly earnings, and of course this is seasonally adjusted in a time series. It's going back to 1935, and this is a logarithmic scale. So just to be clear, earnings are not this linear. So and when you think about when you think about a logarithmic scale, I mean it really is exponential. So we've had this chart, if it was written on an analog scale, would look more like this over time. And so to break it down into a logarithmic scale shows you that the overall trend in quarterly earnings on an annualized basis, have grown about 6.5%. Let's call it maybe average up to 7%. You get a dividend yield of maybe 1.5 to 2%. That gets you at about a 9%-ish annualized return over this time frame. And so, what would typically be expected in a normal year would be about 6.5% earnings growth. And, they're showing this channel here, and that we are expected to be kind of at the top end of that long-term channel in terms of earnings next year. Here we have a chart from Goldman Sachs. It speaks directly to the not necessarily stock action, but the annual earnings growth. And so, I say that sales is the mother's milk of business growth and earnings and stock price growth and all of that. Well, obviously you've got to have sales to have earnings, but to the extent that you have earnings, which the Magnificent Seven has had a lot of, and so there's no doubt and debate whether, or debate over the influence of the Mag 7 in overall stock valuations. But as you can see here, we see a deceleration in these positive earnings. Not that they're going to dip below the rest of the S&P 500 stocks. And, of course, 2023 was a very odd year where we actually didn't have significant growth in the rest of the index like we did with the Mag 7. But that changes here in 2024, and again, overall earnings, when you look at it, it's probably more like around here when you look at the overall index. But this is the disparity when you break it down. This is what a lot of people are talking about. But that begins to dissipate next year, and we look into 2026. There's going to be, a lot of contribution to earnings from the rest of the 493 stocks in the S&P 500 index, and I think that's very good for the health of the market. Well, something that we definitely need to talk about is the enthusiasm and investor sentiment. And so this is a survey question from the conference board. This is the percent of respondents that are expecting higher stock prices over the next 12 months. And you can see that this is really in kind of uncharted territory. And I think the same goes if you were to extend this time series back from 2005, well back into the 1980s and 90s. So we are definitely in rarefied air here in terms of the optimism related to the market. And here we have the response in from some of the rest of the 493 stocks. Again, we've been talking about that PE and that valuation gap likely to narrow. Well, we already have evidence that that valuation gap is narrowing, and this is the percentage of the S&P 500 members that are above their 20-day moving average. Now, this is a pretty quick turn. 20 days is really not a big moving average. I mean, you begin to see real trend lines when you get out like 50, 100, and especially 200-day moving averages. But the good news is that we have greater participation. And I put this chart over here and to show you that it's not just in the large caps. I mean, it's in mid caps. It's in small caps. I mean, we're seeing greater breadth across the market across all major asset class levels. Something else I've been kind of very interested in here is the private market relative to the public markets. And as we've talked about ad nauseum here, public market valuations, I believe, are a bit stretched. That doesn't mean that the market's not going to go up next year, because I think it will. Current estimates are anywhere between 10 and 15% for overall earnings growth and overall market growth with no multiple expansion. Maybe that's a little optimistic, but clearly we see here in this chart that we've got S&P 500 and S&P 600, which represent small caps. And you can see that the enterprise value, the EBITDA multiples, and call this a very loose proxy for earnings multiples, but you can see that those have gone up both in the S&P 500 and in small caps. But what's really interesting here, very interesting, and we see this in private equity. The private equity multiples are actually moving down, and it's odd, I think, to see this at a time where you're seeing public equity markets really begin to shine here. And so you've got basically all levels of private equity here are witnessing declining multiples. And it comes at an interesting time where PE firms are really flush with cash, but they're witnessing declining exits right now. Well, something I look at, in an effort to kind of sense the optimism on the part of publicly traded companies, is to look at their capital spending plans. And so this is a chart that helps to do that. So you've got here the quarterly capital spending or CapEx growth on a percentage basis, on an annual percentage basis year over year. And so you got technology firms, and this would include that Mag 7, and then you've got the overall S&P 500 excluding the technology sector. Again, speaking to the breadth of the market, obviously we've had a lot of technology spending, but we see this little fishtail hook in the rest of the market. And this is important really for a number of reasons. And obviously we've been in a period of decline over a couple of years, and to see positive trends here really is optimistic to me. It shows that you've got corporate spending on infrastructure, on production capacity, and on property, plant, and equipment that is basically increasing right now. And so, we've talked about the manufacturing sector being in that kind of prolonged rolling recession of sorts, and we saw earlier in some of the regional Fed charts that the manufacturing surveys are getting better, and that's manifesting itself here in capital spending growth. And of course, it's got a long way to go to catch up with technology spending. But when you talk about, this representing kind of the rest of the 490 or so stocks in the S&P 500 index, I think that really bodes well for the health of the overall economy, as well as the health of publicly traded America. Here we have Treasury gross issuance as a share of nominal GDP. You can see very clearly that that line is continuing to move up and will likely continue this basic trajectory here. So what does this mean, Eric? Well, I mean, obviously, if you got more issuance, you're having to fund your deficits. And we know that those are not going away likely anytime soon, because neither political party seems willing to embrace fiscal restraint. So as a result, we're going to have more issuance on the market. And just think about that in supply and demand terms. If you have more Treasury paper on the market, that is likely to depress prices and keep your yields higher. And so that's what I think we're seeing in this forward read through of this number right here, is that this is going to be something, because of these lingering deficits, it's going to keep those interest rates higher than they otherwise would be. And so, that has lateral, or collateral impacts on prices and asset class rotation and things like that, but it's going to help to support overall yields across the spectrum. All right, we've got a couple of a forecast for you. We've got Deutsche Bank and we have a Goldman forecast in here. So I thought this was very interesting because this data on this side really doesn't lie. I mean, this is the implied distribution of the outcomes for the S&P 500 ending price at the end of 2025. And let's start here on the left-hand side. So again, channel-based, they're looking for trend growth of 12.5%, and these bands represent a difference of 12 percentage points on either side of that. This goes back to 2007. They're looking at basically 7,000 as their target, which, based on today's prices, would be essentially it'd be about 16%. So, I mean, we're at 6,000 more or less now. This is calling for 7,000. That's pretty optimistic, right? And so this probability distribution chart, for those who love statistics like I do, this is where Deutsche Bank is looking at right now. And, we're a little bit above where this was published, around 6,000 here, but the highest probability comes into play around 6,500, which itself would be about 8.5% S&P 500 gain from here. And I think, this is probably the area that we wind up in at the end of the year. Slide, we have the Goldman Sachs iteration of their estimate, and you can see their trajectory continues to move higher, over the next couple of years, and this actually probably extends out a little bit closer to 2027. I'm not going to get too carried away. Let's just worry about 2025 right now, because that's essentially 12 months away. And so just like I showed you in that last slide, I mean, Deutsche Bank is looking for something more like 16, 17% growth in the market. I think Goldman Sachs, if you draw the line of best fit here, probably looking at something closer to like 6,500, which is about 8.5% gain. I think that probably makes a lot more sense, just because I think, we're going to have more volatility overall in the market next year. And I think we've enjoyed kind of an unusual period of outsized of or not outsized, but muted volatility rather, which has helped to support asset price growth. But I do think that's going to change a little bit next year. So another chart from Goldman Sachs here, not too surprising because we've been observing this trend for a number of years. And the risk asset is definitely on, and we're at record levels of relative ownership of equities across the individual spectrum. So we've known that this trend has been increasing because of 401ks and defined contribution, but this is also representative of an increasing trend towards individual ownership of equities. And obviously they get a lot more press than debt does, and cash for basically 10 years hadn't really paid you that much, and so not too surprising to see cash and overall debt be relatively muted because of lower interest rates for a very prolonged period of time. But it is rather surprising to see that overall investment ownership has gone up tremendously, and that most of that has gone into equities. And so I think what this does is it helps to contribute to potential volatility because you have individual Americans, individual investors that are less savvy on balance. I mean, this is what the theory suggests, that they tend to be more impulsive, more emotional in their investing, and they tend to make decisions that are somewhat irrational relative to intrinsic value and things like that professional money managers would typically spend more time looking at. And so, the potential here, again, as I mentioned in the last slide, my expectation is that volatility is going to pick up next year. I think maybe this contributes to it. Again, policy at the federal level is going to be pretty interesting to watch, and it's going to be, I think, actually somewhat impactful to the pace of volatility. But nonetheless, this is a very interesting trend that I've been watching for quite some time. The last slide here just represents the average real economic growth forecast. This is Goldman Sachs once again relative to the consensus estimate. You can see here, this is again for 2025. Goldman is basically looking for about 2.5% real GDP growth, and rest of the investing or the estimating economists here are calling for about 2%. Honestly, I think this makes a lot of sense right here, about 2%, although it could be much larger. But you can see the expectations for Euro area, UK and Japan, relatively muted. China, which has had a bit of a slog lately, kind of getting back, not to prior levels, but getting back to something that looks a little bit more like 4.5%. And then emerging markets, which are expected to also witness, their typical outsized economic growth. But, a couple things to note about EM, that, EM includes China, and this is ex-China here, just to be mindful of that. But what's interesting is that I think overall EM, this is a really relatively good number. And so, emerging markets are at a massive value disparity to the S&P 500. And even if you look at international numbers, and they're pretty, the international price to earnings levels, the investment multiples relative to the U.S. investment multiples are significantly lower, and this would suggest that there's a reason for that. However, that valuation disparity is at like multiple decade lows. So I do see value, even though overall growth rates are not expected to be as great, say like in Europe. But I do think emerging markets are a value that can be realized, and I do think that over time the value disparities, you can capitalize on the value disparities in international investing. That's all the charts that we have for this week. I hope you have a wonderful start to December, and hope to see you next week, and have a great week. Take care.